Welcome to another 2-Minute Finance for Expats. This guide comes to you with the help of our friends at Esquire Group International Tax Advisory. Our topic today is FATCA. Most American expats have heard of FATCA. Some know what it stands for. A few know what it actually does, but what's most unanimous? They don't like it. FATCA stands for the Foreign Account Tax Compliance Act and became law in 2010. Many expats incorrectly believe that FATCA is the law that requires them to report and pay US taxes on their income. That's not the case. Expats have always been required to report and pay tax on their worldwide income in the US. It's just that pre-FATCA, it was difficult for the IRS to enforce worldwide taxation on expats because they had no access to expats' foreign financial information. FATCA changed all that. FATCA places reporting obligations on both foreign financial institutions, like banks and brokerages, and on the US connected person, US citizens, green card holders, and those meeting the substantial presence test. Foreign financial institutions, FFIs for short, are required to report the accounts of US connected persons and entities substantially owned, 10% or more, by US connected persons to the IRS. Generally, they must report the US connected person's name, taxpayer identification number, account number, year-end account balance, and the gross receipts and gross withdrawals or payments from the account. Pursuant to FATCA, US connected persons must file Form 8938 if they meet the applicable filing threshold. Form 8938 requires the US connected person to report their foreign financial assets and related income. Foreign financial assets include, for example, bank accounts, brokerage accounts, and ownership of foreign entities. The Form 8938 filing thresholds for US residents who file single or married filing separate are $50,000 or more at the year end, or $75,000 or more at any time during the year. Those thresholds are doubled to $100,000 and $150,000, respectively, for US residents who file married filing jointly. The thresholds for US connected persons who are foreign residents are a bit higher. The Form 8938 filing threshold for US connected persons living abroad who file single or married filing separate are $200,000 or more at year end, or $300,000 or more at any time during the year. Again, those thresholds are doubled to $400,000 and $600,000 respectively for those who file married filing jointly. Don't forget, you still must report all your income from foreign financial assets on your US tax return, regardless of whether or not you're required to file Form 8938. In closing, FATCA does not impose tax. It simply imposes reporting obligations on foreign financial institutions and US connected persons that allows the IRS to more effectively enforce US tax laws. All the IRS has to do now to determine if someone is compliant is compare the data received from the FFIs with the US connected person's tax return and make sure it matches. If not, they know the person isn't compliant and take enforcement action. FATCA is nothing to be scared of, and it doesn't increase your tax liability. Just report and you'll be fine. Thanks for listening, and remember, we're expats too.